Most trained accountants spend several years at a college or university earning a degree in accounting. That degree, along with a job in the accounting field, makes them a true accountant. If you're not an accountant, your experience was probably a lot different. You probably didn't go to college to study accounting. Maybe you've never even worked as an accountant or a bookkeeper. And you were probably not hired for a job that included accounting or bookkeeping in the description. One day, you realized, in addition to your normal job duties, you've also become the company's bookkeeper. You've got a big challenge in front of you. First, you need to learn QuickBooks. Second, you need to learn some about accounting. You don't have to become a CPA, but some knowledge about accounting basics and financial statements makes using QuickBooks that much easier. Next, you're going to learn the basics of accounting and the financial statements. If you're new to accounting, this might be the most important part of the training. Let's talk about the most important list in QuickBooks, the chart of accounts. You probably won't look at this very often, but I bet you'll use it every day. For example, when you use a debit card to purchase office supplies, you need to enter the expense and assign the bank account that funded the purchase, along with an office supplies expense account to describe the purchase. Both the bank account used to pay for the office supplies and the expense account you used to categorize the purchase come from the chart of accounts. In fact, that's the purpose of the chart of accounts. It helps you categorize the financial transactions of your company. And as you've already learned, one of the goals of accounting is to track the why you spend or make money. The chart of accounts is the hub of all of your accounting system. Every transaction you enter into QuickBooks affects the chart of accounts. So if you want to know exactly how your business is doing, you'll need to take a look at the chart of accounts. But just looking at the chart of accounts can be very overwhelming. So to do this easier, accountants developed two financial statements that summarize the chart of accounts: the balance sheet and the profit and loss. Each account in the chart of accounts appears on one of these two basic financial statements. Next, you'll learn about the balance sheet. Then later, about the profit and loss.
Let's talk about the balance sheet. Select Reports, Balance Sheet. The balance sheet is a financial snapshot of your business at one moment in time. Think of someone taking a giant camera and snapping a financial picture of your business right now. That would be your balance sheet. Let's look at the elements of the balance sheet. The first section is called Assets. Assets are all the stuff the business owns. Notice the balance for checking, accounts receivable, and inventory. This is all the stuff the company owns. Scroll down the report and you see the business's total assets. The next section on the balance sheet shows liabilities. Liabilities are what the company owes to people outside of the business. For example, this business has some accounts payable, credit cards, and payroll liabilities. QuickBooks also shows the business's total liabilities. The last component of a balance sheet is equity. Equity is what a business is really worth to the owner. For example, let's say you sell this company today. The line shows your total assets. You receive a check for the full amount and deposit it in your personal bank account. Then you need to pay the liabilities of the business. What's left in your account after you pay those liabilities is called equity. In other words, equity equals assets minus liabilities. This is what the business is worth to the owner. Use the balance sheet to see how your business is doing at one moment in time. Let's talk about the second financial statement, the profit and loss statement. Choose Reports, Profit and Loss. During the last topic, you learned that the balance sheet is like a financial picture of your business. Consider the profit and loss statement to be more like a financial movie for your company, because it shows how you did over a period of time, just like a movie. The profit and loss statement has three major sections. The first is income. This is the money that the company generates from sales, or in the case of a nonprofit, donations and other fundraising activities. For this business, income accounts include service income, construction income, design income, and more. The second section is cost of goods sold. This is the cost of the products you've sold or the cost of providing your services, like construction labor and materials. It's key to note that these costs are directly linked to sales or the generation of income. Overhead and fixed expenses appear later. The last section is called expenses. Expenses represent costs paid by the company that are not directly related to a sale or the generation of income, such as advertising and bank service charges. Remember, consider the profit and loss statement as the movie of your business. The most important part of a movie is usually the ending. If it's a great ending, that's what you remember. If it's a bad ending, that is what you remember. The profit and loss movie also has an ending. It's called the bottom line. It shows whether you made money. The financial movie has a happy ending. The net income of this company is positive, which means that the company is showing a profit this year. How does QuickBooks calculate the net income? The math is simple. Take the total income, subtract total cost of goods sold, scrolling down, subtract total expense, and voila, you have a bottom line. Click Accounting to open your chart of accounts. Remember, each line in the chart of accounts becomes a line on one of the two financial statements. So make sure your chart of accounts is set up properly to get accurate financial statements.
The most critical choice you make when setting up an account is choosing the right type of account. Account types serve two purposes. First, QuickBooks uses the type to identify where the account appears on your financial statements. For example, a bank type shows on the balance sheet under the heading Checking or Savings. An income account shows on the profit and loss statement under the heading Income. If the account type is not correct, your financial statements will not be correct because your accounts won't appear in the right place. Second, the account type determines how QuickBooks uses the account. For instance, suppose you want to write checks. When you set up the account, you must choose bank as the correct account type. It is absolutely vital that you use the correct account. If you don't know which account to use, reach out to your accountant for assistance.
Our company just purchased a new computer, but the chart of accounts doesn't include any account to track the cost of computers. Let's add one. Click Accounting. Then select New. Choose the appropriate type of account, Computers and Fixed Assets. Think of the detail type as an added description of the account. It doesn't affect how the account works, but it's still required when setting up a new account. Just choose a detail type that best describes what you're tracking. Type the name of the account, Computers. The description is optional. Let's leave it blank in this example. If you're setting up an asset that you already own, enter the original purchase price and the date it was purchased in these two fields. Since we're purchasing a new computer now, we'll leave them blank. When finished, click Save and Close. Now the new account is included in the chart of accounts. Does the new account appear on the balance sheet? Let's have a look. Choose Reports, Balance Sheet. Scroll down the balance sheet to the Fixed Assets section. Computer equipment does not appear on the report. Why? Accounts with zero balances do not show on the balance sheet. Let's record the purchase of a new computer. Click the New button, and then Expense. Click the Payee drop-down arrow and select Computers by Jenny. We used our debit card to purchase the computer, so we'll make sure checking is the payment account. Now enter the appropriate account. Click the Category drop-down arrow and select the new Computers account. The new computer costs $2,500. Click Save and Close to record the purchase. Now the Computers account appears on the balance sheet. Remember, only accounts that have a balance will appear on the balance sheet. When you look at the chart of accounts, the accounts to the left are parent accounts. And the accounts indented and below the parent accounts are subaccounts. For instance, insurance is a parent account, and equipment insurance, property insurance, and workers' comp are all subaccounts. Subaccounts allow you to track finances in more detail by grouping related accounts and showing a subtotal for those accounts. Let's look at this on a profit and loss statement. Choose Reports, Profit and Loss. Scroll down the report. Here are the insurance expense accounts. QuickBooks groups the subaccounts together on the report and calculates a total for all insurance expenses. What subaccounts do you need in the real world? Whatever accounts are necessary to manage your business more effectively. For example, look at our cleaning costs for this year. Do you need more detail about cleaning on your financial statement? Do you need to know how much it costs to clean the office versus the restroom? No. $1 amount for cleaning is enough information. Insurance is different. This is a significant cost in certain industries. You can have multiple levels of subaccounts. Let's scroll down to look at an example. You track advertising as print and web. Print costs are tracked in even more detail, brochures and newspapers, while web costs are tracked in more detail with banner ads and social media. QuickBooks supports up to 5 levels of accounts, a parent account, and 4 levels of subaccounts. So you could set up a subaccount of a subaccount of a subaccount of a subaccount of an account. You need to buy insurance for a computer you purchased. Let's add a subaccount to track the insurance. Click New. Choose Expense as the account type and Insurance for the detail type. Type the name of the account, Computer Insurance. Select the checkbox next to Is Subaccount. In the next field, enter the parent account for this subaccount. Click the drop-down arrow and select Insurance. When finished, click Save and Close. Let's find the insurance accounts. There is a new subaccount below Insurance called Computer Insurance. Now that you have insurance for your computer, you can rest easy knowing it will never, ever break. You can also edit an existing account to turn it into a subaccount. Notice that this company has a rent expense account. But there is also an office rent and machine rent account. So to find out how much we've spent on rent, we have to look in 3 places on the profit and loss. And it's also pretty confusing when recording what we rented. Let's change that. Find the account you want to make into a subaccount and click its Action drop-down arrow. Then click Edit. Now just select the subaccount of checkbox and choose the account you want to put it under. Now click Save and Close. The account is now a subaccount and much easier to use. In the next topic, you learn about another benefit of subaccounts. Subaccounts allow you to collapse reports. Click Reports and then Profit and Loss. Let's scroll down to look at Utilities. QuickBooks automatically displays all of the subaccounts on the profit and loss statement. There are many instances where you don't need this detail. For example, if you apply for a loan, the banker doesn't need to see the detail for electricity, gas, or telephone. They want to see utilities in total. To hide the subaccount detail for a single parent account, click this arrow. Now the utilities account appears as one line. To see the subaccount detail, click the arrow again. To hide all of the subaccount detail, click Collapse at the top of the report. To see all the detail again, click Expand. Collapse reports to make them easier to interpret and read.
Before QuickBooks, accountants had to prepare a special entry in order to affect accounts and financial statements. This entry is called a general journal entry. A journal entry is where you encounter those pesky little debits and credits that accountants went to school for so long to learn about. Teaching you how to use these debits and credits would be like trying to teach you to be an accountant. It is way beyond the scope of this class. Instead, you should only enter journal entries that are prepared by your accountant or bookkeeper. there are 3 reasons why you might enter journal entries into QuickBooks. Number 1, to enter transactions that you cannot with a built-in form. For example, when you use the check form, you use it to cover handwritten checks. You use an invoice, you use the invoice form. But what about a transaction like depreciation? Most editions of QuickBooks do not have a built-in QuickBooks form or window for depreciations. Or what about prepaid expenses? There is no built-in form or window in QuickBooks for prepaid expenses. When there's no built-in form, use a journal entry. Option 2, to correct errors. For example, your accountant found an error that affected 100 individual invoices. Rather than correcting each invoice, your accountant can prepare one journal entry to correct all of those invoices. Option 3, to make year-end adjustments. Your accountant might give you a list of entries after they review your books. Usually you enter year-end adjustments with a journal entry. However, if you don't have an accounting background, real-world training recommends that you only enter journal entries that were provided by your accountant.
The accountant just sent you a journal entry for depreciation. Select the New button, then Journal Entry. This is the journal entry number. QuickBooks automatically numbers your journal entries. For the first line in the entry, click the Account drop-down arrow and select Depreciation Expense. This is a debit for $250. Type a memo, Monthly Depreciation. For the second line of the entry, click the drop-down arrow and select Accumulated Depreciation. This is a credit for $250. QuickBooks enters the amount for you. Click Save and Close to record the journal entry. Remember, if you don't have an accounting background, real-world training recommends that you only enter journal entries provided by your accountant.
Let's discuss the difference between accrual and cash basis reporting. To best demonstrate this, let's look at the profit and loss statement. Remember, this report shows your business and how it's doing over a period of time. This report shows that you've made almost $16,000 in profit this year. But when you log into your bank's website and look at your balance, you see that your statement is almost overdrawn. How can this be? You're making money, but there's no money in your bank account. The reason is usually the difference between cash and accrual basis accounting. By default, QuickBooks runs reports on the accrual basis, which means that invoices show as income whether or not they have been paid. Bills that you owe to vendors also appear even if you haven't paid them yet. To see just the actual dollars, run the report on the cash basis. A cash basis report only shows income when the money's been received, and cost of goods sold or expenses only when that money's been paid out. Now that we look at the same report on the cash basis, it looks like we're losing almost $24,000. Time to start collecting on all those invoices. Remember, you can switch between cash versus accrual at any time. But when it comes time to filing your taxes, choosing between cash and accrual is something you should discuss with your accountant.